Today's financial challenges are uniquely tied to your net worth. And with the rise in repossessions and foreclosures, many are struggling to find equity in their largest investment, their homes. Banks aren't making it easy to borrow money, and for many, refinancing is not an option. Every day, thousands are falling victim to the financial violence that is rarely seen as a crime. For the next few moments, pay attention closely to what you're about to hear. Many have found ways to return value to their American dream. You will hear from real people who are just like you. They are homeowners with mortgages, graduates with student loans, consumers with credit cards, and all are fed up with the high interest payments and the business as usual attitude of banks and lenders who just want your money. In this presentation of the pill method, you will learn how you can pay off any interest-bearing debt, like a 30-year mortgage, in record time with no change to your current budget and without getting a second job. The pill method was created to help regular, everyday people understand how money works and how they can leverage their own money for themselves in the same way the big banks leverage your money to help make big gains for their investors. Are you ready to hear how real people just like you were able to find ways to truly maximize their money? Are you ready to hear how you can eliminate thousands in interest payments? Can you imagine a 30-year mortgage being reduced to less than 10 years? It's all possible because of the pill method.
You know, when you go in, you typically, to get a home loan, you typically try to go for the lowest interest rate. You really don't know what points are. You really don't know what interest, the real interest paid on it. You really don't know how the payment schedule is set up. You don't know anything. You just know you mess up 2 months in a row, they're coming after you. So this allows you to have the tools and allows you to peek behind the curtain to see how these things are timed out, how they are calculated, what you can do to use some of the tricks that the bank uses to leverage your own money, your own sense of wealth, to empower yourself for financial freedom in the future.
The pill method stands for prepayment of principal, isolation of principal amounts, leverage, and liquidity. We're going to go over the amortization schedule and what that means to you. We're going to borrow $200,000 from the bank, and the interest payment on that is 6%. The term is 30 years or 360 months. Now, what we're going to pay back is a total of $231,676 in interest. That's if we make every payment on time, not being late even once. Let me ask you a question. If you borrowed $10 from me and I asked you to pay me $20 tomorrow, what would you say to that? No? Why is that? Too much interest? How much interest am I asking for? 100%. Well, if I borrow $200,000 and I pay back over $231,000, isn't that in excess of 100% interest? And all of us do it. It's about time that we stop doing that. That's a total repayment of $431,676. That's a total interest paid, as you can see here, of 115.839%. Let's go over prepayment of principal and see how we can reduce how much interest we actually pay without affecting our budget in a negative way. All right? Listen, the borrower's right to prepay, when you first see that, is on the mortgage note page. And it says something like this: I have a right to make make prepayments of principal at any time before they're due. A payment of principal only is known as a prepayment. When I make a prepayment, I will tell the note holder in writing that I'm doing so. I may make a full prepayment or partial prepayments without paying any prepayment charge. Very crucial. Now, a lot of clients ask me about prepayment charges, and what about prepayment penalties, they ask me. And I say, well, I have a 30-year mortgage. I'm going to pay it off in 8 years. I don't have to refinance. My mortgage payment stays the same, and my monthly bills don't increase. Well, I'm saving $300,000 in interest. If I'm saving $300,000 in interest, how big does the payment penalty have to be for me not to save that kind of money? Let me ask you, if the prepayment penalty was $10,000, would that still be okay? If the prepayment penalty is even $50,000 and I'm saving $300,000, would that be okay? The bank is counting on you not doing the math. They're counting on you to hear prepayment penalty and continue to make all 360 payments and return that 100% interest. Let's see how we can avoid that. On your screen, you can see that we have the first payment of that mortgage of $1,199.10. $199.10 goes to principal, and $1,000 goes to interest. We see here at the end of the month, we owe $199,800.90. The month-end balance is used to configure the next month's payment. Again, the month-end balance is necessary to configure the next month's payment. So, as we can see here, we put the $199,800.90 in that formula that I showed you. Once we do that, it tells us how much interest we owe on the very next line. And as we can see here, it's $999 in interest, not $1,000. So it's going in the right direction, just not fast enough. What can we do about that? If we take a look at that $200.10 on line 2, let's see how we can use the information we learned from the mortgage note page, how we can use that to our benefit. That $200.10 on line 2. Line 1 here, if that's January and we make that payment, the amount that we should pay in February to principal is $200.10, correct? But do we have to wait till February to make that principal payment? You're right, we don't. If we had it, we could pay it in January. And if we did, wouldn't we be paid down to right here on line 2, $199,600.80? We'd be paid down to there in January, wouldn't we? If that's the case, then which payment are we going to be on in February? You're right, it's line 3. What happened to the interest on line 2 if we're already on line 3 in February? No, it doesn't go down. It goes away. You never have to make that payment ever. Your total interest bill has been reduced by almost $1,000 by giving the bank $200 early, $200 you were going to give the bank anyway. Let's see what else we could do with that. Now, what if I just make that payment in January anyway, and then get a little fancy with it and take a look here at the next 3 principal payments? What would happen to the interest payments on that line if I gave the bank a little over $600 on top of my mortgage payment in January? What would happen to these 3 interest payments? You're right. They disappear too. Now, that's almost $3,000 of interest eliminated. Did you ever believe that your mortgage worked like that?
We started this program in officially, I think, at the beginning of 2009. So almost 3 years now. We've been using it every single month, and we are on track to pay off our bills in a little less than 8 years. That's our 30-year mortgage and 4 student loans, some furniture on a credit card, and a car payment as well.
How powerful is that information? Do you want to learn something even more powerful? All right. Well, let's take a look at isolation of principal amounts then. Now, as you look at column 1 and all the principal payments in column 1, as you can see there, they add up to $2,456 and a penny, and you see that at the end of column number 3. $2,456 and a penny, that's how much we would pay if we made every payment on time. We would reduce our mortgage by that much. How much interest does the bank want us to pay? Take a look at the bottom of column 4, and what do you see? $11,933.19, nearly $12,000. Folks, how fair is that? Well, listen, let's see what we could do about that. If we know we're going to pay $2,456 and a penny, because it's here on the screen, $2,456 and a penny, we know that. Let me ask you a question. Do we have to pay it in 12 monthly installments? No. If we had it, we could give it to the bank in January, couldn't we? Well, let's say we do. Let's say we give it to the bank in January. See what happens. If we do, let's subtract the $2,456 and a penny. Let's subtract it from the $200,000. Let's see what happens. We would owe $197,543.99. Isn't that the same amount that's right there on line 12, month-end balance? So you're saying if we gave the bank that money, we would be paid all the way down to line 12? If that's the case, then our next mortgage payment would be on line 13, wouldn't it? Now, if our next mortgage payment is going to be on line 13 in February, what happened to all the interest payments between line 2 and line 12? Gone. Disappeared. Nearly $11,000 eliminated, and 11 monthly mortgage payments you never have to make by giving the bank the same amount of money you would have given them in the first place. Let's take a look at what happens next. What if we didn't have the $2,456 to give to the bank? Let me give you an example. Now, my program doesn't work exactly like this. I'm just giving you this example so you could see how the banking system works. What if you were to borrow $2,456 from a friend of yours and just ask them, how much is the bank paying you in interest on your savings account? Less than 1%? Well, ask your friend. Now, don't really do this because if you do, they'll be mad at me. So don't blame it on me. So what you want to do is we're just pretending here. Let's borrow $2,456 and a penny from your friend, and then give that money back to them in a year at 10% interest. Your friend would jump on that. Now, we'll take the money from the friend. What are we going to do with it? Apply it to the mortgage payment and pay it all down to line 12 in 1 month using whose money? That's right, your friend's money. All right? And now once you do that, don't you eliminate 11 monthly mortgage payments? Isn't your next mortgage payment in February now on line 13? And are you not saving almost $11,000 in interest using your friend's money? Now, you're going to take that money and pay it back to your friend. You still owe the $2,000, but you're going to take the same year to pay the same amount of money at 10% interest. At simple interest, the interest payment on $2,456 and a penny, around $245. You just paid this mortgage down to line 12 for $245 interest instead of nearly $12,000 interest. Folks, I ask you, Which is better? How powerful is this information? Do you want to see something even more powerful than that? All right, let's talk about John and Rebecca Jones. John and Rebecca Jones have this same mortgage, and they are so happy about the fact that they are paying their bills every single month on time, including this mortgage. And they've finally paid their mortgage down by $10,000. It took them 45 months to do it, but they're there and they're happy. They're having a little party to celebrate. And as we all come over to the party, then you've actually been to my class, then you ask John and Rebecca, how much interest did you pay to pay your mortgage down to line 45, to pay it down by $10,000? And they say, well, we don't know. They go over and over their filing cabinet and pull out their mortgage papers, and they start looking, and to their horror, they see that they paid $43,939.97 in interest. They don't feel much like partying anymore. In fact, they kind of ask us to leave because they want to hang on to their food. All right, so that's a total of what? $43,000 in interest, $10,000 in principal. That's almost $54,000 paid out for a $10,000 benefit. Who pays that kind of money for anything? I tell you what, I know if I look hard enough, I can find something around my house that's worth $10,000. How would you like to pay me $50,000 for it? You tell me where to walk it, I will walk it to your home for $40,000. I will, I promise. All right? So here's what we're going to talk about. Let's see how we can pay down this same mortgage by $10,000 for less than $5,000 interest instead of $40,000. Now, if I show you how to do that, will you promise to use the information? Will you use that money, that extra, that $40,000, that interest money for your family instead of giving it to the bank?
Well, it's God that provides us with our incomes. He gives us the strength to even make incomes. We can't even do that without the strength that God gives us. And just a simple summary: why spend money that you don't have to spend? We should maximize our dollars. There are many projects that need attention, and one of the reasons that we are provided with the incomes that we're provided with is to serve in our communities. We're not just to hoard our monies, we're to use that money for good. So why throw away money that you don't have to throw away? If we are aware of where our money's going, let's not spend what we don't have to spend. Particularly if we're doing it in a legal way. We should maximize our dollars. And if I can buy my house for $10, then why spend $15 on it? So we need to maximize the money, but the biggest problem I think that most of us had, at least that I had, is that I wasn't aware of it.
All right? We're now going to explore leverage. Now, I just love using somebody else's money. But, you don't have to use borrowed money. I love using borrowed money, though. But let's just make it very clear. The minimum requirement is a checking and savings account. Do you have a checking and savings? Well, then you can use the program. All right? But let me show you what happens if we should use borrowed money. Is that okay? John and Rebecca Jones have a line of credit. And they go to their line of credit. They write out a check for $10,000, and they put in the memo, apply to principal. They write out another check to go to their mortgage and send that check anytime during the month, that same month. So that $10,000 is paid to their mortgage in the same month they make their regular mortgage payment. You following me so far? Well, if they do that, look what happens. Aren't they paid down to line 45 anyhow in the same month? And if they're paid down to line 45 in the same month, Their next mortgage payment is on which line? Line 46. You got it. Now, if they're paid down to line 46, what happened to all the interest payments between line 2 and line 44? Gone, you say? Eliminated? Well, that's what? A total of interest saved $41,988.83. That's pretty good savings. Now, they still owe the $10,000. In this case, they owe it at 8.6% interest. Now, I need you to catch that. 8.6% interest? They're using 8.6% interest money to pay down a 6% loan. On the face of that, does that make sense? I'm going to show you that we should be concerned about interest cost more than interest rate. Let me show you how by focusing on interest cost, we can save a lot of money. Now, John and Rebecca Jones took this $10,000 from the line of credit and applied it to their mortgage and paid it down to where they owe about $190,000. They also owe $10,000 on the line of credit. Is that correct? All right, so by doing that, they still owe about $200,000, don't they? They haven't increased the amount of their indebtedness. But to pay back just the $10,000 at 8.6% interest, do you think they can pay it back for less than $40,000 in interest? Let's just see. So as you can see here, John and Rebecca Jones aren't rich. They make $5,000 a month. Their expenses, $4,000 a month, which means they have $1,000 left over every month. Mrs. Jones takes that $1,000 and puts it away. She needs an emergency fund. Makes her feel secure to know that they have something to fall back on in case something happens. Well, John and Rebecca Jones are going about this thing in the right way. Mr. Jones is asking questions about his money as well. Now, they make Mrs. Jones, $1,300 twice a month. Mr. Jones, $1,200 twice a month. That adds up to their $5,000. Now, when they take their $5,000, it's direct deposited into their checking account. Question: how much are checking accounts paying these days? 0% interest. At least mine is. How about yours? All right? So 0% interest. And what does the bank do with the depositor's money? Invest it and make more money with it. Do you mean we put our money in the bank month after month after month and not make a dime, and they take that money and lend it out for new cars, homes, and credit cards at 15% interest? We signed up for that? Well, I think we need to start asking more questions about our money. What do you think? Listen, so let's see what happens. Their money, instead of the money being deposited into the checking account, what do they really need to do? John and Rebecca Jones just need to pay their bills on time, don't they? Let's see if there is a different way they might be able to do that. Mrs. Jones gets paid this Friday $1,300. And instead of putting it in the checking account, she takes her $1,300 and applies it all to the line of credit. Can she do that? Yes, she can. And when she does, she's paid down to about, the line of credit down to about $8,700 at 8.6% interest, which means she's paying less interest on the line of credit. That same money was used, that same money from the line of credit was used to save, what, $40,000 in interest on their loan, on their mortgage? It sounds like they're saving twice using the bank's money. Is that fair? Oh, I'm trying to elicit a little sympathy for the bank here. Okay? Anyway, let's see what else happens. Mr. Jones says, listen, I like that idea, putting the money in there, paying less interest over here, I'm going to take my paycheck and do the same thing. He takes his $1,200 the next week and puts it in the line of credit. When he does that, the line of credit is paid down to around $7,500. Now, just to be fair, we need to understand that the bank charges interest on a line of credit on the average daily balance. But for expediency's sake, let's just say they're going to put all their money into the bank account, into the line of credit, and over the next 2 weeks, they're going to put another $2,500 in. That's a total of $5,000, and they owe $5,000. Now, you and I know it's going to be a little over $5,000, but we want to just keep the math simple here, okay? So they owe $5,000 at 8.6% interest. Let's figure out how much interest they will pay in 1 month. So we take $5,000, we multiply it by 8.6% interest, we come up with $430. We want to know how much they pay in 1 month. We divide that by 12. When we do that, we come up with a figure of $35.83. Let's recap what just happened. John and Rebecca Jones borrowed $10,000 from their line of credit. When they took the money from the line of credit, they applied it to their mortgage all in 1 month. They saved over $40,000 in interest and eliminated 3 years, 7 months from their mortgage payments. They did it all in 1 month using the bank's money. And the bank charged them for the use of that money, what? $35.83. Pretty good use of their 35 bucks? I think so. I think so. So now, what happens next? They still owe the $10,000 on the line of credit. So they take their $5,000 and put it in. But they still need to pay their bills. Right? So John and Rebecca Jones say, listen, we've taken care of our paychecks in here, and the paychecks are working for us now. Let's see what happens. On here, they put in $5,000. They owe $5,000 on the line of credit, and now to pay their bills, they take out $4,000 of the $5,000 they paid in and pay their bills on time. Their balance now on the line of credit, $9,000. Now, it was $10,000, but now it's only $9,000. Why is that? You're exactly right. The $1,000 left over at the end of the month. They put in $5,000, but they only spent $4,000. Mrs. Jones was doing what with her $1,000? Putting it in a bank account for a rainy day. At what? Less than 1% interest? 1.5% maybe? I don't know. But it's not a lot. But now that $1,000 is working. Does she still have access to it in her line of credit? Yes, she does. And which is better, making 1% with her money or saving 6% on her mortgage with that same amount of money and still having access to it? You're right. Let's see what else happens with that money. Now, if they take that money, their income, and put it in the line of credit, $5,000, and pay their bills every single month, $4,000, that means there's $1,000 left over and paying down that line of credit at $1,000 a month. The next month they do it, they'll put in $5,000 and spend $4,000. When they do that, at the end of the month, they'll owe about what? $8,000. If they do it again the next month, they'll owe about $7,000. So the question is, how long will it take them to pay back the $10,000? 10 months. That's exactly right. Now, at 10 months, remember, how much did they pay in interest the first month on the line of credit? $35.83. And we have a declining balance on the line of credit. All right? And as the balance declines, that means we're going to pay less and less interest on the line of credit. Well, let's not try to do all that math today. Let's do this. Let's just round off the interest on the line of credit to $35 a month. $35 a month for 10 months is how much money? That's right, $350. Total interest saved, $41,988.83. Total interest cost to accomplish that, less than $350. Folks, can you beat that anywhere? That's prepayment of principal, isolation of principal amounts, leverage. Do you like those so far? Let's take a look at the last letter. The last letter is liquidity. Now, Mrs. Jones was putting that $1,000 away in a savings account, right? Now what she's doing is applying it to the line of credit where she still has access to it, where it's saving her a lot of money. Now, I once heard somebody wrote that a penny saved is a penny earned. Exactly, that's Benjamin Franklin. So she is saving big time money in interest not paid. It's just like earning that kind of money. Where else can you pay $350 and get a $40,000 savings or $40,000 return on your money? All right, so what? Now, John and Rebecca Jones their $1,000 every month is going into the line of credit. And they're paying off their mortgage faster, aren't they? All right? And as they're paying off their mortgage faster, have they increased their budget in order to do it? No, their budget is the same. So the $35 that the bank is going to charge them in interest, they got a bill for. When they received their bill, it said, you owe us $35. But the bill also said, you don't have to send us $35. Why is that? Because you gave us $5,000. You looked at it as a deposit. It was really $5,000 in payments towards the line of credit. Every time their paycheck went into the line of credit, they got a receipt for a payment. They'll never make a scheduled payment to that loan. Now, once they got that cleared up, the bank says, because you've given us $5,000, we were only looking for $35, you don't have to send us any more money, so we'll take that $35 and add it to the balance of the loan. Are they paying down the loan in an accelerated fashion? Did it cost them any more money per month in order to do that? Has their budget risen at all? No, not even by the $35.83. And I would suspect all of you here would have paid the $35.83 to accomplish that goal. So, and the $1,000 left over every month? Do John and Rebecca Jones, do they still have access to that $1,000? Absolutely, which means they stay liquid through the entire process. That's prepayment of principal, isolation of principal amounts, leverage, and liquidity. Thank you very much.
Prior to watching this DVD, many of you thought that all that interest that you're currently paying was the cost of doing business. You've just learned that nothing could be further from the truth. Now I have one simple question for you. Are you looking to simply save some money? Because if you're looking to do that, you can actually do this on your own. However, if you're looking to save the most amount of money possible with little to no adjustment to your monthly budget, then the key to it is optimization. You see, imagine a financial robot that will take a snapshot of your personal financial picture. It will determine which account to take your income and store it, leveraging your funds. It will even determine to what day and how much down to the penny, goes towards interest and towards principal, guaranteeing you that you pay the least amount of interest to your mortgage, student loans, and even credit cards. The other factor is interest cancellation. You see, interest cancellation simply takes the funds that you have going towards interest, reallocates it, and puts it towards principal with little to no adjustment to your monthly budget. If you want to learn more about that, then get with the interest cancellation specialist who shared this DVD with you. And in addition to that, here are just a few of our happy clients. Thank you for watching.
Take Six is, I've always said, Take Six is a lifestyle. It's not even a career or a job, it's a lifestyle. You're always one of the guys. It's not exactly special forces, but we can get a call at any time. You gotta have your pack and be ready to go. I literally left Thanksgiving one night for South Africa and took off 27 hours, got down there, sang, turned around and came back. This Tuesday coming up, I'm going to Shanghai, China. Within the last 2 months, last 2 weeks, I've been to Brazil, all over the place. I just did a red eye from California coming in here to Atlanta, just non-stop, always going. And that's just the Take Six side of it. And when I'm home, I'm also doing the Hollywood Shuffle, which is anything that anybody's hiring for. Yes, I can do that. Yes, I can do it. You figure it out by the time you get there. You don't realize how your financial life impacts everything. I'm talking about it impacts your relationships, your marriage, your approach to family life, the kind of time that you have to share and give. When you start getting your affairs in order, you start working out, and it might sound melodramatic, but you start tightening up the areas of your life. It's like different things that you just kind of let go on autopilot. You just kind of ATM your life. You don't do that. I don't expect my life to take care of itself. I do what I need to do for my life, for my marriage, for my family, because I'm proactive with everything now. I take lots of flights to Atlanta and LAX. I like going there back and forth, but I never fly myself. You want somebody who is a professional doing what they do. Your financial life there are world markets that are clicking around the clock. There are things that impact every second of the day. And for you to think that you can do what you've never done, like you've never done it without the tools, it's just not going to happen. You need a powerful software. You need somebody that is going to have the tenacity, the mental fortitude, and the character to be able to usher you through these scary times in a forthright and in a manner that is going to get you to your goals and to your freedom.
Rosenblum Realty has been serving the Huntsville area for 55 years this next year in 2012. So it is it's an exciting time for us. My great-grandfather and my grandfather started the company back in 1957. So my father is the operating broker. I'm fourth generation coming into it. And Rosenblum Realty is just sort of a household name. People locally here know who we are, and it's been a great benefit for us. Every single client that I work with, I recommend this program to everyone. Whenever we sit down and we start talking about, my goodness, I've got a 30-year mortgage, I'm trapped for life, I've sold my life away to my home now. I sit down with them and I say, I want to show you just how easy it is to pay off this mortgage in a third of the time or less. But because I'm doing it. That's what I'm doing right now. So I recommend this program to every single one of my clients that I'm faced with every single day.
I first saw the house and I had to have it. I had looked at probably 40 houses, maybe 50, over a period of a number of months. And I knew that when I saw it, that would be it. I never will forget telling Doug that I found it. And when he saw the house too, he was like, nice house, but And as the more we consulted with our advisor and looked at the pill method and sat down with Don, who introduced us to the program. When you introduced us to the program, we knew that it was transferable. We knew that it could make sense not only for the property that we were in, but if we wanted to move into another property, we began to do some math and exploration and came to the conclusion that we actually could afford this very beautiful home. We could afford to pay it off. We would not be locked into it at our age for a number of years. And I mean, for 30 years, I mean, we'd be 90, 100.
That's definitely not going to happen.
So what happened is we looked at the house, and in our consultation, we could see that it was a dream that really could come true, that made sense. And we looked at it as an investment. And the way Don Daniel put it to us, the pill method makes your investment a dream that you can actually live in. You can experience it while you are considering it your investment. That was very wonderful.
It was like someone had just taken blinders off of me. I remember when Don explained that program to me, I popped myself in the head and said, "Oh, it's just as clear as day." You know, once he broke it down, like I said, the bottom line is we don't really understand where our money goes. We don't understand what we are being charged to have what we have, and it's right there in front of you. And it's like I remember that day. It was like a revelation. You know, whoa. Yeah, and it's not like it was hidden information. It was laying right there in front of you, but you just don't see it. And I think that's the strength of most of the financial institutions, is that they hope you don't see it. But there is a way to avoid, thanks to Don, I see there is a way to avoid paying money that you don't really have to pay. And that's the thing that got me.